Hello, good afternoon, and welcome back to the FinTech stage at CogX 2020, the first fully online CogX that ever existed. And I'm told that there's people all over the world watching us at the moment, which is fantastic. But for those of you who've come back from lunch in the UK, we hope you had a good lunch, and we're about to dive straight into the green finance panel. I might ask, is there another kind? I probably don't think there is. It all has to be going forward if we're going to survive. But to lead us in this session is Shân, Millie from the brilliantly named Bright Blue Hare. Shân, can you please join us?
Hello there, Eric. Hope you can hear me.
Great to have you. Yes, we can hear you perfectly. Just so everybody knows, Shân is not going to have a camera, but we can see a great picture of you there, but she's still going to lead the session. Shân, would you mind just telling us a little bit about you and what you do, and then lead on straight into introducing your guest, and have a great panel.
Thank you very much, Eric. Appreciate it. And thanks for the vote of confidence on the name of my little business as well. Appreciate it. So hello, everybody. Yes, I'm Shân, and I'm your facilitator for today. And one of the reasons that I'm here facilitating what I know is going to be a fabulous discussion is around innovation, which has been my passion and my professional obsession for most of the time that I've been working, actually, but latterly focused on my adopted home market of insurance. And insurance innovation, I think, immediately takes us into the big innovation drivers. And what I've learned personally over the past 12 months, possibly coming to the party a bit late, but nonetheless, what I've learned is that climate change and transition economy is one of the biggest innovation drivers that there is. So if you're interested in innovation, you have to be interested in green finance. So that's the context for me. But let's get on with today. CogX's theme this year is getting the next 10 years right. And that date's not arbitrary, because as we know, the consensus is that not limiting warming to 1.5 degrees above pre-industrial times by 2030, certainly modelable, but actually to the average human being, to be honest, quite unimaginable. So there's a real pressing requirement to recast how we live to be climate sustainable. And it's become mainstream for many countries, part of government economic policy. Most people will know that here in the UK government's green finance strategy has 3 core ideas. 1, greening finance. 2, financing green. And 3, turning excellence in both of those areas into a national competitive strategy. So financial services is recognised as essential to the decarbonising or transition economy, but some also see it as being inexplicably slow to grasp a massive opportunity for growth in new revenues, which, let's face it, are pretty thin on the ground at the moment. Some people have put a number in the order of $150 billion on that growth opportunity. So this session is not just for experts or even professionals working in FS. I'm thrilled to be bringing you 3 individuals who are deeply involved in different and sometimes overlapping ways in green finance. And really, really importantly, all of these guys are interested in breaking down silos, wherever those silos are, professional knowledge, expertise, whatever, because they see that as essential to their own commercial goals. So in a moment, I'm going to ask Martina, Paul, and Nicole to introduce themselves to you. They'll take about 2 minutes each. And then we'll use our allocated time for discussion until about 2:45 or so, when we have the scheduled comfort break, as you know. So you will have been briefed that there is a massive opportunity for you to put your questions directly. So do use Slido. We'll be trying to catch up with those a little bit later on. But Martina, let's come to you first and give us your 3 minutes. What do we need to know about Martina and green finance?
Sure. Thanks a lot, Shân, and thanks a lot, CogX, for making this opportunity possible to talk about sustainability and technology-enabled strategies, of which I will highlight a few during this discussion. My name is Martina Macpherson. I'm a Senior Vice President at Moody's for ESG engagements and the President of the Network for Sustainable Financial Markets. And I would like to highlight 3 points. Up and foremost, trusted data and analyses and the role that trusted ESG data plays in investment decision-making. Ultimately, understanding for and of systemic ESG risks and opportunities as investment performance drivers, especially in post this COVID crisis, and ultimately the development of green finance, sustainable finance tools and solutions for active and passive management, and the role that these play in order to grow the understanding and momentum of ESG investing. So up and foremost, around trusted data. So the importance to understand is that the digital transformation has started. Decision makers are literally looking at data in the investment sphere and beyond for their day-to-day decision making. The aim is to fuel innovation and to take advantage of new opportunities, new business models, but ultimately also within the bounds of regulatory obligations and requirements. So trusted governance, data and information has a key role to play to empower data scientists through data governance, to break down information barriers and biases, especially when we look at self-disclosure and reporting, and to modernize the information architectures and structures for what we call business-ready and real-time ESG data and AI-enabled ESG screening solutions. Second point, again, understanding of ESG systemic risks and opportunities as investment performance drivers. I'd like to highlight, and we're discussing that, I'm sure, in a moment, that we have seen that ESG funds have actually well performed during the COVID-19 crisis. In the first quarter, they've been faring far better than their peers and the broad equity markets. And while companies are taking action to curb pandemic efforts and effects, literally innovation, investment in people, in R&D and technology have become key factors to determine also the long-term value creation and success of these organizations at an entity and at a portfolio level. Again, we will hopefully highlight that this is just not a short-term phenomena. Ultimately, positive performance linked to corporate social performance is a factor that has been assessed in academia and in industry, and that's going to stay. Last but not least, development of green finance tools and solutions for the active and passive domain. What does that mean? The ESG market is estimated to be around more than now $30 trillion US. That was the figure at the end of 2018. We're expecting a market report by the Global Sustainable Investment Alliance at the end of this year. So labeled green bonds, another big market momentum, have reached more than 250 billion of issuances at the end of last year, up from initially less than 10 billion less than a decade ago. So ultimately, there are massive opportunities here for investors. Inflows, especially also during the crisis. I should highlight that a Morningstar report recently looked at ETFs, passive funds, and iShares in this segment, and it was estimated that these passive instruments alone have gathered $10.5 billion US in the first quarter. So what does that mean? Hopefully, we will look at that in more detail. It means we need to define and establish rules-based approaches for ESG, SRI, and impact investing that will also help us to build the relevant classification frameworks for products and investment approaches. Thank you very much.
Fantastic, Martina. Thank you so much. So lots of opportunity there. Paul, can I come to you?
Sure. Yes, well, thank you very much, Shân. Thanks for the opportunity to participate today. And thanks to everyone at Cognition X for staging this panel as well as all of the other ones. This is a great opportunity for people around the world to understand more about the changes that are taking place in many sectors of the economy. So I'm going to be disruptive right off. I think we should be referring to this approach to finance as sustainable finance, as Martina suggested. Green is not broad enough anymore. Green, of course, is what we've started with over 30 years ago, because the initial focus in this part of finance was on the environment, and it's still a crucial part of what we are doing on a day-to-day basis. But more and more, the social aspects of this industry are becoming prominent. If you just look at what's happening in the US right now related to the racial issues that are exploding onto the streets in terms of demonstrations and all of the considerations that companies are now having to go through at the boardroom level to determine what their policies are going to be related to these issues, among the many environmental issues and other social issues that are already on the table. So corporate governance, the G in ESG, is at a point where it has to put up or shut up, frankly. And the US markets are, as Martina said, dramatically increasing the flows of assets into more sustainability and ESG integrated portfolio strategies. Now, I come to this work from over 20 years as a financial advisor and 6 years as a consultant to financial advisory practices, asset managers, and other people in this part of the industry. I also write for industry publications, and I host the Sustainable Finance Podcast, a weekly program where I discuss with leaders in this part of the industry how they are approaching, from a personal and professional perspective, the work that they do to increase the asset management flows for sustainable investing, both here in the US and around the world. I'll just close with saying that I believe the developing markets around the world are the next most important area for ESG investment and diversification. And we should be looking at those markets and focusing on where the data is coming from those markets just as closely as we do in the developed markets on a day-to-day basis. Thank you.
Thanks very much, Paul. And Nicole?
Thanks so much, Shân. Thanks to CogX again for, I assume, an inaugural subject matter, but hopefully one that will gain dominance and presence for its run, however many years CogX is a main stage for and a platform for voices like ours. So I'm Nicole Anderson. I run a business that is focused on financial services innovation for a number of years. I have always focused predominantly on the topic and tension of financial inclusion throughout my work. Most of all, I have had a journey that has taken me organically across many a continent in many different challenging situations to solve problematic issues with gaining or providing liquidity and access at grassroots level to either small businesses or individuals. It is through that work that thankfully I got exposure to project finance, specifically capital intensive project finance in the last couple of years, which helped me really understand the connection between really new business models that were troubled and struggling to gain capital, but were really symbolic of a new way of working, a new entry point for many traditional industries. I'm talking specifically about energy and real estate construction, and really the blend of my work working in financial services and these transformative industries was this huge catalyst for me to actually dedicate myself to looking at the innovation opportunity in sustainable finance. So I come at this panel from a private market perspective. So what essentially does the private market investment and innovation opportunity offer? This huge, much needed change. How I, like you, Shân, believe this is probably the biggest innovation opportunity finance has ever seen. And time is not on our side. And I think I'm a strong believer in the human entrepreneurial drive. And I'm really delighted that we have the showcase of what fintech has been over the years as a precedent for what is going to be absolutely essential. And so the innovation opportunity that I care about and look to source in order to invest in and provide support to includes areas of unlocking capital. It's a big issue. It's a massive issue, specifically in private markets, because of integrity of data that exists in public markets, of course, but even harder to ascertain in private markets. Emerging technologies that are so essential in the transition to a greener state for the global economy. I'm also hugely interested in the tightening liquidity challenge. We will hear probably even in this panel how much capital is available in global capital markets, but yet it's not getting to where it needs to get to, and how can innovation solve that? And then finally, of course, this subject is all about intelligence, data, and making sense of traditional forms of data, but more and more real world data. And then I myself, being in an area of how private markets need to reinvent, I'm particularly interested in how venture capital, which has the greatest possibility to have impact because of where it's focused on pioneering young ideas and business models, how the venture community itself innovates in order to be more sustainable, which, dare I say, we could argue it has not been in the past. So thank you.
Dare to say, Nicole. That's what we're here to talk about. Okay, that's fantastic. Thank you. So 3 really deep sets of experience and ideas and different stakeholders and different ways of in your own rights making a change in this arena. Paul, I'd like to come to you first. I mean, you've built your professional life around being having had an aha moment way before it was remotely fashionable, if you don't mind me saying and alluding to the fact it was quite a long time ago, Paul. Making investment choices yourself and also advising others to do the same. I mean, retail investors, as well as the work that you're doing now and your educational work, obviously, through the Sustainable Finance podcast. So to listen to you talking, it's kind of like, well, it's a no-brainer, right? That's kind of what one takes from your 3 minutes. So if you could just take a couple of minutes to explain what you think is a no-brainer for whom and a bit of the why, Paul, just to fill in a little bit more of that.
Sure, Shân. Well, thank you. Of course, when you've been doing anything for a long time, it's much easier to sound like you know what you're talking about than when you are shorter in terms of years of experience. What Shân's referring to is the aha moment that I had in 2002, related to my personal journey as an investor and a financial advisor, as well as the work that I was doing with my investment and advisory clients at that time. In 2002, we were in the 3rd year of just awful abuses within the financial services industry. And I was very close to ending that career and trying to find something else to do with my time and energy. And fortunately, several people that I knew suggested that I speak to folks who were pursuing a more sustainable approach to portfolio strategies for their companies and their clients. And it turned my head around completely. It was a complete shift in my focus as an advisor and as an investor. And over the next 5 years, it enabled me to double the size of my practice, because what I found when I started speaking to my clients was that they were very interested in what I had to say about a more sustainable approach to investment strategies, even if the conversation had never started up to that point in time. So I think it's very important for anyone in an advisory capacity in our industry to make sure that their constituency, whether it's the clients they work with, the community they live in, and or people that they would like to work with, know about their focus on sustainable finance and investment. It's not enough to just do it within your practice. So that was my aha moment and my head turning and complete change and diversification of my practice. And that led to, like I said, a lot of success, and eventually to what I'm doing now. I started consulting to financial advisors at that time as well as a coach, and that led to my current role as a full-time consultant and podcast host for this part of the industry.
Thank you, Paul. So just one more question there on the no-brainer aspect of this.
Sure.
I mean, we don't have time to go into everything that I know all three of you could talk about in terms of what the developments have been, what the changes have been. Let's just maybe focus on the fact that we're living through the pandemic at the moment and investments have been having a pretty bloody time. I mean, would your argument be, if you want proof of the pudding, just look at the results from portfolios that have more ESG in them than not?
Yes, I'll go first, but I would like everyone to participate, Martina and Nicole as well. Here's my take on the shift in the way assets are being allocated at the moment during the coronavirus pandemic, is that we come to watershed events in financial services and the capital markets once or twice in a generation. This one, I believe, is as important as the events that happened back in 2008 and 2009, and several times in my career prior to that. We are literally in a time where a huge amount of capital is questioning the way that it has been invested through the people who manage it and the people who own it. And I think that over the next few years, we will see trillions of dollars of transition assets to a more sustainable, ESG-focused portfolio strategy, whether it's in the public or the private markets.
Thank you, Paul. So Martina, like Paul, I mean, you've spent most of your professional life working in and shaping and pushing forward one aspect or not of what is now ESG investing, but obviously it's been through many permutations. Picking up those points around that tipping point moment or evidence that this is an unstoppable process now, possibly emphasised by COVID and other elements that around financial inclusion and the other things that both Paul and Nicole and yourself mentioned. So what would your perspective be then around it being kind of a no-brainer?
Yeah, very much so. Just what Paul and yourself have highlighted, Shân, this resonates. Ultimately, I briefly throw out a couple of numbers here. The $30.8 trillion of the sustainable investment market at the end of 2018, estimated to be even higher than that now by the end of 2020, with obviously very strong performance of ESG investment funds, active and passive, over the last quarter during the crisis and beyond. But I also highlighted that this is not a short-term phenomena. I've been in this industry for a long time, first on the investment management side, then on the service provider side. And I've seen this socially responsible investment arena growing from the fringes up down to and into the mainstream, with actually a focus on a variety of different strategies, either linked to ESG screening, integration, or engagement. And it's fair to say, when we are looking at two sides of the same coin here, risk and return, that ESG has shown a way and a means for investors to provide that sort of long-term sustainable approach towards value creation. And I give you two examples. One is actually downside protection from risk, which was and has been the key angle for many ESG proponents, backed by the thesis that ESG analysis enhances the analytical perspective by scrutinizing more qualitative value drivers, helping to identify superior managed or governed firms, and for fostering a long-term mindset. That theory still is in place and obviously shows its values. Obviously, in the last few years, pushed by academic studies and then also by industry reports, we have actually seen that there are positive performance signals linked to ESG funds, which are just not a recent phenomena. I'm highlighting here a couple of studies by Harvard Business School and University of Hamburg. Both have collated meta-studies around the correlation between corporate social performance and corporate financial performance, so CSP and CFP. And they found that there is a positive correlation between the two of them, whilst obviously Morgan Stanley, in a recent report of 11,000 funds, between 2004 and 18, so quite over a significant period, encapsulating another financial crisis, found that there is statistically no significant difference in the total returns of sustainable funds compared with their sort of more mainstream conventional peers, but a 20% downside, sort of a 20% smaller downside deviation. So again, this shows you that this is not just a recent phenomena. It's not just linked to opportunities post the COVID crisis. We have seen that over the longer term, these ESG-linked funds have shown positive performance signals that are actually also been very helpful in mitigating previous crises.
Yeah, thank you for that. So, Nicole, when you were speaking, you talked about, and then a few days for possibly talking about venture capital needing to be more disruptive of itself in this whole process. So I'd like to ask you a sort of a larger question, I guess, not just about venture building and venture capital, but I'd like you to sort of dig in a little bit further into those innovation enablers. You talked about new ways of structuring business, new ways of thinking, disrupting ourselves from the inside. So what do you think then? What looks like innovation to you? What are the questions? What are the answers that you think are part of that?
All right. I won't let you off the hook because I would like to come back to the build on what Martina and Paul have so eloquently put forward from a private market perspective. But let me hit this one on the head for you. So I think, what is innovation is such an overused word, and it really should have a special place for watershed, time-bound opportunities where markets are shifting. That is really when you get it's about a timing, it's about a major market shift. It could be within one geographic, it could be a global phenomenon, but when you get this shift, there is what VCs like to call, this opportunity for an addressable market. Now, what we saw with fintech in 2012, essentially, there was this incubation period of 4 years before we really began to see the output of the pains of 2008 come to the fore. Fintech became a global phenomenon, predominantly addressing what Martina called this outside-in requirement, which was predominantly bottom-up. It was predominantly trying to address the pain points for individuals like you and I in as much as how we manage and transact in our daily lives to the businesses we run. It was that very grassroots, retail-based friction that caused the wave, right? That caused to look at the way in which we transact outside banking, the way in which we look at alternative ways to move money, lend, create different ports of liquidity, and of course, insurance is another area. The difference now, this innovation watershed is fundamentally different because I see it as a pincer move. You have absolutely this, this pandemic is a very acute form of what was already on the table, which was contraction of liquidity in global markets. I mean, we still haven't solved that problem. And growing concern that we have this, 10-year cycle to transition industries. And so there's this systemic challenge, there's this very real market challenge. And now you have this overlay of a pandemic, which has essentially been a short, sharp intervention to just normal lives, right? So you have these three conditions coming together. And that's painful in and of itself. But all the while, the issue of sustainable finance has been trying to figure out how it now solves a structural challenge, which is we have all of this, real economy issues, that I've described, but we also have to force through change, and that structural change will come from regulation. It'll come from big institutional movers. It'll come through the likes of asset managers and reinsurers and insurers having to take on this first mover advantage or drive to address the transformation. And so when you think about this overlay of tension, in the middle of it is, a huge amount of reimagination, re-engineering of the financial value chain. So from capital markets right through to, retail markets, there is opportunity to intercept and adapt. And this is, how do we do that? We can force through change, we can force through, we can use carrot or stick. Preferably, we all would like to see a ton load of, I was going to say, orange carrots come to the fore in innovative ideas, but the entrepreneurial mindset feeding into the incumbency of traditional financial services has never been more important than it is now. So I think that would be my take on where we are and where the innovation opportunity lies.
So it's about making that change. Is about keeping the energy high with the people who fundamentally, whether they're inside or outside that incumbent ecosystem that you've described, have a desire to make change. Is that broadly what you're saying there?
Have a desire, and that desire is born out voluntarily, or it's going to be forced upon them.
Yeah. Let's, and I will just to say, Nicole, we've got a really juicy question for the Q&A session that's come through already around access to capital, the challenge of that. So I'm definitely going to come back and have you talk about private market as well. But as we know, Martina, you have to leave us, sadly, at bang on 2:45 because you're being dragged over to another stage, Martina. I'm hanging on to your ankles. So talking about that, forcing the change and the regulatory structures of one kind and governmental structures, which I think Nicole was alluding to. Obviously, that is going to make the need for trustworthy data and process that will structure that rules, make that rules-based approach that's being created by regulators and government and others actually work. So given that, as we've said, you spent most of your professional life working out what's good data and what's not. What do you see could be the blockers, but also the enablers of actually making that, giving the power to those that do want to change and comply, obviously, for them to, what do they need, Martina? What do they need and what don't they have at the moment that needs to be fixed?
Yeah, up and foremost, the disclosure of material non-financial information is becoming a prerequisite. I highlighted briefly at the beginning the inherent biases in the current way of actually how companies / issuers are self-reporting ESG or non-financial or extra-financial, as it's often classified, information. And that is its own inherent data and investment biases ultimately. So disclosure of material information, the movement from normative to regulatory frameworks, we are seeing currently at an EU level in particular is this drive that we are moving away from the normative frameworks linked to ISO, linked to UN Global Compact, linked to ISO standards and many others which have their relevance, and the reporting frameworks linked to the Global Reporting Initiative and linked to the International Integrated Reporting Council, IRC, a link to SASB, the Sustainability Standards Accounting Board, that these sort of initiatives have their relevance, but that we need a move from the normative, more voluntary, to the more regulatory and mandatory drivers in order to encourage better disclosure of material issues. And the EU Commission has put a process in place with the EU Sustainable Finance Action Plan, which looked at the establishment of a new green taxonomy. It looked at the establishment of green bond standards, also very important if you look at the different asset classes in the mix that I highlighted a bit earlier. It also looked at climate-aligned benchmarks and ultimately, again, disclosure of extra financial information. And the EU Non-Financial Reporting Directive, which is currently out for consultation, aims to provide more clarity, transparency, consistency around non-financial information or extra financial information, the way it's reported. And that would actually help us to be clearer on which factor can determine corporate as well as portfolio/investment decision-making success. And it hopefully will in turn help us to establish factors for the long term to build this sustainable and more resilient corporate as well as economy-linked recovery that we are definitely needing beyond this crisis. And up and foremost, it will help us to address the climate, environmental degradation, and human rights issues, many other S-related issues and violations that we are currently seeing, obviously at a corporate entity level, but also beyond that in the corporate supply chains, for instance. And last but not least, why is that important? A couple of studies looked at that, and they felt and have assessed that companies reporting at large is currently still incomplete or even insufficient. There is a lack of clarity when it comes to definitions for non-financial performance, and there is ultimately a market failure in corporate disclosure on sustainability risks, impacts, but also on opportunities.
Okay, so that market failure then is coming, as I understand you, is coming from a variety of places. It's coming from the corporates themselves not being able, knowing their own risks and data and being able to report. But it's also coming, maybe not market failure, but it's also coming from your point of view. We need more mandatory behaviours, literally mandated, than just, well, this is what we've done up to now that we all kind of agree with and it's okay. The normative stuff, as you've described it. Is that would be a fair summary?
A very fair summary. We have, discrepancies and biases across the investment value chain, how this information is reported. There needs to be this dynamic relationship between materiality and what is defined as material for an organization as a material issue and mandatory reporting standards. And they are necessary, especially for issuers. And literally, they are also helping to, in turn, define again the key considerations of materiality. And again, at the heart of the current EU NFRD is this concept of dual materiality, which looks at the one hand at the company's activities and how these activities are linked to externalities, social and environmental, or environmental and social, and the impact on the wider stakeholders in this value chain. And it's very important that we get a clear understanding on who is linked to these material issues and their impact.
There's so much that we could discuss. I mean, I'm looking at the faces of Paul and Nicole, obviously. At the moment, I mean, I think we could have an hour's discussion on who decides what's material, what levels of reporting actually mitigate against certain types of businesses. Paul referred to emerging markets as well. Information asymmetry obviously is what usually makes the financial world go round, right? So there are all kinds of issues in there to be unpacked. And just to say, we've got 4 really juicy questions for our Q&A session from 3 o'clock. Sad we're going to miss it, Martina. But I think what I'd really like to do now, given that we've got about 6 or 7 minutes before this session comes to its formal end. Actually, Josh is telling me 10 minutes. Okay, Josh, thank you. What I'd really like to do is, as I said earlier in the introduction, June 5th was World Environment Day 2020. Let's track forward to World Environment Day 2021 and to ask the unfair but totally necessary question of each of you. What's going to have happened for good, bad, or indifferent between now and then? Paul, I'd like to start with you, please.
So 12 months, is that what you're asking for, at 12 months?
Yeah, is that okay?
Okay. Well, I think it's different in different places. In the EU, clearly, the whole mandated disclosure process, as Martina has articulated, is moving forward from a legal and regulatory and lawmaking perspective. That's very important to set the standard for the entire global marketplace. On the other hand, in the US, what you see right now is tremendous social disruption driven by the refusal of our regulatory bodies to address these issues on an ongoing basis and dive deeper into the corporate issues that are systemic, particularly related to diversity and disclosure. So, for example, I recently did a podcast with a woman of Asian descent who is a board member of the 30% Coalition, which is a nonprofit organization that promotes the elevation of more women into senior corporate and board level positions. And I was shocked to hear from her when we were preparing for the program that as an Asian woman, she represents in the United States economy almost 40% of total consumer spending. And yet on corporate boards in the United States, Asian women are represented by only 3% of corporate board members. That's a huge disconnect. Those boards, most US corporate boards cannot possibly understand where a significant portion of their consumer base is wanting to spend their money, what they are looking for in terms of the products and services that they want to pay for. And that's one example of many that are out there. So I think we need huge infrastructure influence from the EU, making its mark in the US gradually over time. As you all know, we're incredibly stubborn here in the United States when it comes to making change that disrupts our very personal freedoms.
Yeah,
but it's time for those things to happen. And
okay,
I think
what's a possible question then, basically, from your point of view. Martina, what about you? Sorry, we're running out of time.
Sure.
So 12 months.
Absolutely. Yes, very important points that Paul has highlighted. I would also say the three key themes or trends that we are seeing here. One is, I highlighted a bit earlier, that thematic S focus, and S investing means ultimately also investing into equality and diversity in the active and passive context. It means also looking at broader S human governance related issues, as well as health and well-being. And we have seen some of the macro investment strategies in these areas have been recently very much refocused on specifically the S arena. The second part, the transition from E environmental to E plus S, that's environmental and social, is also happening in other asset classes. I highlighted the emergence of ESG bonds or sustainability bonds. So social sustainability and most recently SDG bonds have actually emerged as these new mechanisms to address some of the public social funding gaps, and they're here to stay. I mean, Moody's estimated that the social and sustainability bonds market is this year going to stay around $100 billion versus other areas. The green bonds, for instance, are unfortunately slightly underperforming versus their initial estimates of around the 400 billion in total, which means the 300 billion mark for potentially green bonds alone. And then the last point I wanted to make, and this is very close to all of our hearts as well, is the fintech and AI enabled and led investment, which is coming. These sets of technologies and opportunities also linked to then the identification of the relevant themes is an ever emerging field. You know, for instance, ESG data screening and enablement in these areas. And we obviously have more time, Sean, the two of us with other experts, to explore that during a dedicated webinar that we are kickstarting on the 6th of August, which is hosted by Moody's. So delighted to explore a bit more.
Time for a quick advert in there, Martina. Well done.
Absolutely.
And just to say, Paul and Nicole, we did have a nice juicy question about growth in the under the fintech umbrella, but from 3 o'clock. Nicole, 12 months from now.
So 12 months from now, I think my hope, it's not necessarily, I'm not the best in terms of a profit or anything, but my hope is we have to look at ways in which we mainstream sustainable finance, which is a multi-tier, multi-level activity. I think there is no room to hide. So whether it's public markets wrapping their heads around addressing the disparity in terms of, the issues of taxonomy unification, I definitely see this as a huge challenge that the EU is tackling and probably will lead, which I believe will therefore lead to an innovation bias to Europe. I think, ironically, the EU has plenty to answer for, the UK has plenty to answer for, but through all of that, I think there is a window of opportunity for us to be a lighthouse to the world, to show how it could be done, because a lot of the regulation will guide clarity, and that clarity will provide, the entry points to think differently. I would like to see a lot more committed fund capital allocation, both in private and public markets, to solving the issue. I would like to see a lot more boisterous, bold moves in terms of structural changes, in terms of how funds are designed and allocated. I'd like to see more innovation on financial products and financial business models. And finally, I would like to see a lot more education for the consumer. And that, I hope, can be achieved in 12 months.
Wow. Fantastic. Wow. Yeah. Let's have a little lie down now, apart from Martina, who has to scoot. And thank you so much for that. We could have carried on for a lot longer, so I do thank you. Thank you so much. And Paul and Nicole, we'll see you back here at 3 o'clock. And just before we finish the session, I need to hand back to Eric, who's going to say goodbye.
But it's the saddest goodbye ever, because I love this panel. I mean, I know Bruce Forsyth would say you're all my favourites, but you really are my favourites. Thank you so much. And also a very big thanks to Shân for graciously and diligently steering the discussion and the conversation of what is going to only become even more important as we progress through the rest of 2020. Look forward to seeing whether those 12 months predictions come true in 12 months' time. Now, for those of you with the right kind of ticket, where you can join the Q&A, you will be able to join this Q&A a little bit later on, and you'll see the link to that. But then the next session that you'll have on here is the future for professional financial professional and legal services, how technology, digitalization, and AI will transform corporate performance, also at 3 o'clock.
Want access to more CogX videos? Subscribe now for free at cogx.co.